Okay, so now we're moving on to the part three, which is our macro outlook. Well, rather, it's my macro outlook, but let's just see what I think. It's interesting times, isn't it? Okay, so macro outlook. It continues to be a little bit complicated, doesn't it? I mean, it's very difficult to sort of, if you've read any books on economics or studied it, to sort of see how it sort of relates to today's economy and actions by central bankers, possibly. But of course, the markets are always constantly evolving, conditions are changing. And of course, central banks are so active in every area at the moment. So I think that complication is pretty much worldwide. There's more countries flirting with recession, and of course the EU demonstrated that last week as it narrowly entered into that technical recession. I think the problem is, this inflation is just refusing to drop to central bank's 2% target. And, they still have that determination, which will mean that there's going to be more rate hikes. Okay, they might skip one, they might pause, they might do something, but they're not going to give up. So, central banks will and happy to accept a recession because it's easier for them to boost an economy than for them to tame inflation. I've mentioned this for months and months. Now, on top of that, I do expect these job losses to start to grow, as you saw in jobless claims last week. I think that's regardless of all this hype that there's been around not enough workers. I think that's just relates to certain sectors. Now, I also expect that rates will remain at their peaks throughout the rest of this year. I really cannot see them just coming down at all. Okay, if there's a massive crisis, then perhaps, but I don't think a recession constitutes a crisis. I think, as I say, that, that's not so much in the central bank's planning, but maybe it was. Even Canada and Australia sort of reinforced the fact that rates are going to stay up for longer as they hiked again, which surprised many in the markets. But again, look at last week's post that I did, in these YouTubes. I pointed out that possibility. Now, further proof of fears of recession are demonstrated in oil, I would say. Now, OPEC Plus cut a second time. The Saudis are going to give up 1 million barrels a day from July. And they've extended, the cuts that they're going to do into the end of 2024 now. And, oil had such a weak push up. It definitely wasn't a meaningful rally, and then just came straight back. I mean, oil's sort of comfortable around about $70 at the moment. And it can probably go $5 either side, but I just think it just sort of really sort of enforces the expectations that demand is going to drop for oil, which usually comes with a recession, of course. Still on inflation, so data in the US leading up to the FOMC will probably be the deciding factor. For me, if CPI comes in above 4%, then I would expect them to do another hike regardless. Now, there's more doves appearing on the sort of the Fed voters. They were speaking about that before they went into their silent period. And if it comes in lower than 0.4%, then it is possible for them to skip and then take another look in July. I think whatever the decision, I would pay plenty of attention to the dot plot. That shows the expectations for future rate levels from the Fed voters. Now, the dollar remains a little bit vulnerable, although that said, I just can't get away from the fact that I believe they've still got the strongest economy. But let's not get too deep into that for the moment. So, Although there's consolidation, it seems as though the Dixie, the dollar index, is sort of just ranging at the moment between 102.50 and 104. Again, there's going to be probably some big moves around leading up to the middle of the week, and then after the Fed's decisions, we could see sort of quite some big moves. Now, apart from corporate greed keeping inflation high, I would say, especially in the food sector, let's be honest, costs are back to pre-COVID and pre-war levels. But of course, consumer demand remains elevated. Now, okay, if we look specifically at the US for the moment, they've still got so much sort of money in the system, number one. But it's not just that, but there seems to be plenty of cash around still. No, not the Treasury, not Yellen. I mean, they haven't started yet. Now the debt ceiling's been raised. I mean, they're going to have to go in sort of really fast and aggressive on sort of getting the money back in for them. What I actually mean are the households. With this relentless performance of the stock market, these equity markets just keep sort of steady, if not moving higher. And of course, now these households have gone back to having these, huge asset valuations of some $149 trillion. And that even takes into account a drop in property values of around $617 billion, and that lower cash held of around by $415 billion. But so don't get your trillions and billions confused there. And indeed, household wealth is $35 trillion higher than pre-COVID levels. Now, of course, much of this wealth is centered around the high earners, and many of the low and middle earners are just living from paycheck to paycheck. But while this, while we're still on to the US, I've got to mention Trump. No, I shouldn't, but I am going to. So he's been indicted yet again. And to me, this just, it still seems that they really don't want him to challenge Biden at the next election, which now, when you think about it, is probably, just less than 18 months away. Right, let's get back to inflation then. So, yes, it keeps refusing to drop. It's becoming more and more entrenched. Just remember, they need 0.17% month-on-month inflation regularly to get to that 2% overall target. But the only thing I see sort of is wage and energy costs. The only thing that I think is left now to be an excuse to charge higher prices with, as I say, all those other costs back where they started. And of course, when it comes to food, I'm on a little bit of a mission here. What I'm trying to get out there is support your local suppliers rather than the supermarkets and all these food giants if you can. You might end up paying a little bit more, but the quality's there. And otherwise all we're going to be left with is all these guys, and this is a perfect example of these giant companies of how they can dictate price to us. In the EU, we've got to see this next ECB rate rise of 25 basis points, and they're likely to warn of more to come. And that's, again, despite the fact that they've just gone into a technical recession. Will that deter them? I doubt it. And, it just seems a case of more of a stagnant economy rather than a dropping economy at the moment. As I keep mentioning, my main concern is manufacturing data because it's still pretty poor. And I see that as quite a good indicator of what's going on with consumers. So it seems that, consumers are spending less. So companies, rather than putting their prices down to attract the consumers back in, they're happy to put actually prices up so they sell less for more, which, is their sort of offset for just to keep their bottom lines as high as they've had them. I mean, their profit margins are at the highest levels for decades. So for me, this does sort of highlight that there's the potential for recessions more and more, and sort of probably more than most expect. But I just believe that secretly central bankers are actually pleased that the economy's not crashing, but certainly coming down, and there is the potential for a recession. As I say, it's much easier for them to control and boost an economy that's crashed when they can't control inflation as much as they try. And of course, that's always been because the majority of it's been from the supply side issues rather than demand. Now, I still expect rates higher for longer, remaining at their peak for the rest of 2023. And I do expect job losses, and I expect a lot of these job offers that are supposedly out there to disappear soon. There will be companies cutting back. And of course, the other central bank meeting this week is the Bank of Japan, where it's probably just going to be as boring as usual. So moving on, Russia, Ukraine, that conflict is flaring again with Ukraine taking the war to Russia. There's I've just started a major counter-offensive attacking Russian forces pretty much on all fronts at once. So that's going to be very interesting over the next couple of weeks to see how they get on with that. Hopefully they haven't spread their forces too thin. Next week's YouTube macro outlook should give us that sort of much clearer idea of how things are going to progress, I think. Now, next Saturday, the 17th, I'm in London at Traders Day Live. I'm going to be making a presentation. I'm also part of a panel of trading experts where we're going to be discussing our trading journey so far. Hope you can make it. If you do, please come along and say hi. I'd love to talk to you. And yeah, I'm really looking forward to that. So it should be another fun day. I just love talking about the markets, as you guess. So bringing all of a whole group together, similar to what I did a few weeks ago, a couple of months ago, but for a different company. It should be interesting. Okay, so now we're going to sort of just go through our services again, and then we're going to move on to part 4. So we offer newsletters, we offer workshops, 1-week courses, our comprehensive masterclass that's really going to help you. Apart from gaining all that fundamental knowledge, you get to spend 20 trading sessions with me. Practical sessions, so that's I'm not saying I'm going to turn you into a massive trader in 20 sessions, but getting that sort of feedback from me, that insight from me, is valuable. Now, other things that we offer are trader mentoring. We consult to companies on FX and commodity exposure. Of course, we provide a massive educational content to individuals, exchanges and brokers. If you feel underfunded, why not give the trading challenge a go and see if you can get that funded account. Maybe you're underfunded, maybe you don't want to risk your capital, which is quite understandable. And of course, one of our courses now includes a free attempt at the trading challenge. If you would like to find out more about anything, then contact us at info@symaxfintech.com or directly to me at chris.tubby@symax-int.com. Okay, so now we're going to go into the technical analysis section. So I hope you join us for part 4.